Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, so today Mena and I would like to focus on individual taxpayers. Now, normally in this podcast, we talk about subjects that impact small business owners and people with more sort of complex tax arrangements, which we'll get to next week in next week's episode. But this week, we'd like to just really focus on, the tax planning for individuals. And of course, even if you are self-employed, you still might need to be thinking about this if your spouse is an individual rather than being self-employed, or if you're distributing to other people that are PAYG, you want to start thinking about their tax position and whether they can optimize it. And you might think, well, why are we talking about this in April? Well, we're talking about in April because so we hopefully invite people to start thinking about these things sooner rather than later, rather than the last week of the financial year and rush madly just to put everything in place. So always good to start thinking about these things. And particularly if we're going to make super contributions, considering the volatility in the share market, you might like to bring forward some of those super contributions. And I'm not suggesting now is the perfect time to invest, but at least think about it rather than leaving it to 30 June. It may or may not be the best time to put that money into the share market. So which is a great segue, I guess, Mena, into probably the biggest way that people can minimise tax is concessional super contributions.
That's right. And the cap this year has been increased to $30,000, previously $27,500. So it provides you that little bit extra in terms of the tax deduction and the ability to get more into super. And as Stuart mentioned, markets have been a bit sort of volatile in the last few days as a result of these Trump tariff declarations or announcements. So it's a good time to actually start, even if it's just periodical transfers before 30 June, just to sort of base out those investments leading up to 30 June. And as Stuart mentioned, if your super balance is under 500,000, you could also consider carry forward contributions. So we typically look at these for clients who, for example, might have had a CGT event in the year. So, a large capital gain and, got a windfall amount of cash. If your super balance is under $500,000 and you haven't used any of your concessional contribution caps in the past 5 years, then you can actually use the prior year caps and make a catch-up contribution. And another reason we'll use carry-forward contributions is because it only goes back 5 years, your last year to contribute for the 2018-19 financial year expires this year. So we might consider it for certain clients so we don't lose that opportunity in terms of using that cap.
And the other thing with carry-forward, Mena, is that if your balance was under $500,000 at 1 July 24, but you expect it to exceed 500,000 at 1 July 25, that this could be your last year to actually use the carried forward rules. So that would be another good planning opportunity there.
Definitely.
It's that $500,000 is kind of the key benchmark here to using some of those opportunities.
Definitely.
There's also spousal contributions, Mena. I guess that's not going to save you a whole heap of money, but something to think about.
Definitely. Look, if your spouse is earning under $40,000, you can put in $3,000 into their super fund as a non-concessional contribution. You get a tax offset of $540. So, look, it doesn't set the world on fire, but obviously those $3,000 increments over a number of years can have compounding sort of investment returns. And that, it's $540 is better than nothing, I guess.
And I guess, Mena, if you're thinking about spousal contributions, it means that your spouse is a lower income earner. Potentially you can have a go at the co-contributions as well.
So that's right, Stuart. So if you earn less than $45,000 and put $1,000 into your super fund as a non-concessional contribution, so that means an after-tax contribution, the government will actually give you a further $500 towards your super.
Yeah, again, it's not going to shoot the lights out, but I guess it's being aware of these sorts of things. And if the government's going to put $500 in your pocket, why not take advantage of the opportunity? This is not a tax-saving measure, but another thing that people can be aware of is splitting contributions. So you can do that with your spouse, and the reason that you'd want to do that is if you had a much higher super balance than they did and you wanted to try and even out your super balances to stay below the transfer balance cap, which is just a fancy way of saying the tax-free threshold, you might be able to do that. So which means that after you've paid for the contributions tax, the 15%, so 85% of your concessional contributions can be moved into your spouse's account. Something you want to talk about with your financial advisor to make sure it's right for you. It's not going to change your tax position, but when we're talking about super contributions, it's always good to think about that. I just had a question in the Investopoly podcast, Mena, about the highest marginal tax rate, and which I always say is 47%, of course, including the 2% Medicare levy. But of course, if we don't have the right level of private health cover, we'll pay more than that, won't we?
That's right, it can go up to 49%. And it still amazes me how many people don't have the right level of private health insurance. And there's a common misconception out there that as long as you got private health insurance, it will avoid the Medicare levy surcharge. Now, I need to highlight this is different to the Medicare levy. They're often very interchangeable and people get confused by it. But the private health insurance is supposed to relieve you from paying the Medicare levy surcharge. Now, you got to have an appropriate level of hospital cover. A lot of taxpayers think as long as they've got any sort of private health insurance, then they're well and truly covered. And I'll find that a lot of taxpayers tend to have just extras covers and no hospital cover, which won't let you avoid or won't make you avoid the Medicare levy surcharge. So it's important that you contact your insurer, make sure that you have the hospital cover or the bare base hospital cover to avoid the surcharge. And funny enough, it's actually not a big amount that you'll pay. You'll likely find that your extras covers cost you more than your actual hospital cover.
What is the surcharge? Is it 2%?
It's a graded scale up to based on your income, so it can go up to 2%.
Yeah, so you're probably going to pay more on the Medicare levy surcharge than you would actually get in the insurance. Correct. And you've got then no extra cover. And also I think when people think about insurance, you want to insure against the big ticket items. That's what insurance is there to reduce your risk. Now, if you have a medical bill that's $1,000 that kind of comes out of nowhere, it's not that big a deal. People will navigate that. But if you end up needing emergency surgery somewhere and, it costs you 60 grand, that's the sort of thing you want to insure against. So it makes sense to have that hospital cover in there. What are some other common tax deductions that people miss, Mena, like including their tax return? So
going on further about insurance is income protection insurance. So I find a lot of taxpayers have their policies held within super, whereas if your income protection premiums are actually paid personally or owned personally, you can actually get a tax deduction for it. So we recommend clients to try to hold personal income protection in their personal names rather than the super fund and pay for it obviously before 30 June to get the tax deduction.
They tend to be better quality policies as well, and they provide more ancillary benefits, and that's really important. If you do go on an income protection claim and it's a longer claim, if you break your leg and you recover in a couple of months, that's not such a big deal. But if you're in a car accident and you're off work for 2 years, the ancillary benefits in terms of rehab and all these sorts of things, that's the sort of stuff that you want to lean on and use, whereas the policies inside super are pretty vanilla. So just be careful there. Less tax deduction, less coverage as well. And if you're young, which means younger than me, maybe around Mena's age, in your 20s, 30s, even early 40s, income protection is really cost effective. It doesn't actually cost you that much, but gives you quite deep cover, so it's worth spending or making sure that the policy is good enough. Home office expenses, Mena?
Yep, an area that the ATO is loving at the moment, but obviously you want to capitalise on any sort of assets or repairs that you might need to do to your home office, whether you need a new laptop or anything like that. Maybe bring that expense forward if you want to claim some of it before 30 June. And then you've got your other sort of ancillary sort of deductions such as your self-education expenses. If you're thinking of undertaking any sort of certain courses or anything to help you sort of improve or maintain your knowledge, you might want to get those done before 30 June so that you can claim that expense.
Donating to charity before 30 June by your Carlton membership, is that what you're suggesting? Yeah.
Well, unfortunately, I don't think they're a deductible gift recipient, but that's a lot of money down the drain, unfortunately. Now, when it comes to charity deductions, I think, and I'll touch on this a little bit later, timing of those charity deductions sometimes is good. If you're expecting or having a large income year and that the subsequent year not being so large, you might want to bring forward those charity deductions so you get more of a tax benefit for it as well.
Property, if we've got investment properties, there's some things that we can think about there in terms of expenses.
Definitely. And I think, it comes down to the timing of income and expenses. So based on where you sort of lie in terms of your income this year compared to next year. So if you have a big income this year compared to next year, you might want to prepay interest, for example. So the banks will allow you to prepay a full year's worth of interest generally, depending on the loan product you have. So it brings forward that interest expense. Bring forward certain repairs and maintenance expenses or capital expenses that you might have, just to say that you can benefit from it this year rather than next.
So a good example of that would be if you're planning on retiring, for example, next tax year, get all those deductions in this year because you can offset against other income.
Correct.
The prepaying interest is a bit of a funny one. Unless you've got a variation of taxable income from one year to the next, there's no other benefits of doing it, but something to certainly think about. Is there anything else that we should be thinking about, Mena?
I've just come across a lot of clients recently who work in the public health sector who aren't capitalising on their salary packaging benefits. As we know that, in the public health, there's certain FBT benefits, and as a result, you might benefit from salary packaging such as mortgage repayments, entertainment and the like. Of course, there's limits as to how much you can do per year. But if you're in the public health sector and you're not utilising these benefits, you might want to start looking at these sooner rather than later.
They're called public benevolent institutions. So they could be charities, they could be dealing with sort of poverty, health, disability, so it's really important to understand who your employer is and whether they fall inside of this benefit, which means that you can salary package expenses that would otherwise attract FBT, which is just another tax to dissuade people from trying to minimise tax, really. Anyway, if you are an employee in that industry, you should fully investigate it. So look, there's some of the really common deductions that we see, people have the ability to sort of maximise, but of course it very much depends on your individual situation. I'm sure your holistic accountant can talk you through, if there's anything that's outside of that list that you should be considering. But we think April's a good time to start thinking about these things. You don't want to leave it to the sort of last minute, particularly as super contributions tend to be one of the big ones. And look, you might be able to take advantage, as we said at the beginning, some of that volatility. But hopefully that's worthwhile. And until next week, bye for now.